We all lean on simple numbers to try and make sense of financial risk. But what if those numbers are only telling us, like, half the story? Today, we're going to peel back the layers on the hidden relationships that really drive the markets. We'll deconstruct one of the most common metrics out there to see what it truly tells us, and maybe more importantly, what it's hiding.
All right, let's just cut straight to it with the big question. You've heard it a million times, right? Diversification is the only free lunch in investing. But what happens when all those assets you so carefully picked, your diversified portfolio, suddenly start moving in the exact same direction right when you need that protection the most? Yeah, that's the core problem we're tackling today.
So, to really get a handle on risk, we have to start at the beginning. Before we can measure anything, we first have to ask, why do assets get connected in the first place? We need to appreciate these powerful, kind of invisible currents that are flowing through the entire market all the time.
I mean, think about it. No stock or bond exists in a vacuum. They're all swimming in the same ocean, and they're all getting pushed around by these massive forces. We're talking about huge things like interest rate changes from the Fed, the amount of cash sloshing around the system, or just plain old investor psychology, where everyone gets fearful or greedy at the same time. These are the drivers that cause totally unrelated assets to suddenly move in lockstep.
Okay, so the first tool in the statistician's toolbox for measuring this is called covariance. It's a pretty foundational concept. All it really tells us is the direction of the relationship. So when asset A goes up, does asset B also tend to go up? That's a positive covariance. Or does B tend to go down? That's negative. It's the very first step, but honestly, its scale is all over the place, which makes it kind of tricky to interpret on its own.
And that little problem brings us to the star of our show today, correlation. Because covariance is kind of clunky and hard to compare, we standardized it. We turned it into this simple, clean number that has become the absolute go-to metric for pretty much everyone in finance.
And what's so great about this slide is how clearly it shows why correlation took over. Covariance can be any number, right? Positive infinity, negative infinity. It's unbounded. It's hard to compare an apple and an orange. But correlation? Bam! It's neatly packaged on this perfect little scale from -1 to +1. It gives us not just the direction, but a simple measure of strength too. It just feels intuitive, and that's both its greatest power and its greatest danger.
So the official name for what we're talking about is Pearson correlation. And the key to this whole thing is hiding right there in the definition. I want you to burn one word from this slide into your memory: linear. This metric is designed specifically to measure how well two things move together in a straight line. Just remember that word, linear. It's the key to understanding where this whole concept starts to completely fall apart.
So now that we've got the tool, let's talk about where it breaks. Because that simple, convenient yardstick we all love to use, well, it's got some serious, hidden flaws. It's time to look at the moments when our favorite metric can lead us completely and dangerously astray.
This sentence right here, this is probably the single most important idea in this entire explainer. Just because that correlation number is 0, it absolutely does not mean two assets are disconnected. It only means they aren't connected in a simple straight line. They could be connected in 100 other complex ways that this metric is completely and totally blind to.
And this is exactly what we mean. Correlation completely misses any relationship that isn't a straight line. It misses something called tail dependence, which is just a fancy way of saying it doesn't see how two assets might suddenly become joined at the hip during a massive market crash. And it doesn't get that the market can act totally differently in different regimes. Like, the rules for a calm bull market are not the same as the rules for a panicked bear market.
And here's another huge weakness. We tend to talk about correlation as if it's some permanent feature, like an asset's price-to-earnings ratio. But it's not. It's just a snapshot of a relationship over a specific window of time. The correlation between two assets last year could be totally different from what it's going to be tomorrow. It's not stable.
So if these relationships can change, when are they most likely to change? I mean, when does this instability matter the absolute most? You guessed it, during a crisis. This is the critical, fundamental flaw. In a market panic, everything tends to get correlated to one. All those different assets you thought were independent suddenly start diving together, and the diversification you were counting on to protect you just evaporates. It vanishes right at the worst possible moment.
So, what do we do about this? How do we fix it? Well, we have to move beyond just relying on a single, flawed number. We need tools that let us see the whole, complex, and frankly messy picture of how asset prices actually behave in the real world.
You know, a lot of classical finance theory assumes that market returns follow this beautiful, clean bell curve, the normal distribution. But the reality, as you can see here, is so much wilder. Real market data is often skewed to one side, returns tend to cluster together, and most importantly, it has what we call fat tail.
So, what in the world are fat tails? It's really just the statistical term for the fact that extreme events, we're talking huge market crashes or massive rallies, happen way more often in the real world than our neat and tidy models would ever predict. The tails of the distribution, which represent those rare events, are just a lot fatter in reality than they are in the theory.
And here is why that matters for our whole discussion on correlation. The calculation for correlation is super sensitive to these extreme data points. A single catastrophic day, a fat tail event, can dramatically skew the correlation number for an entire year, giving you a really misleading picture of the typical day-to-day relationship between two assets.
Okay, let's bring all this home. Now that we have a better understanding of correlation's flaws and the messy reality of how markets actually move, we can start to build a much smarter, much more robust way of thinking about financial risk.
So what's the big takeaway here? The goal isn't to just throw correlation in the trash. The goal is to use it correctly. You need to treat it as a starting point, an input, but never, ever as the final answer on risk. Always acknowledge its limits. It's blind to anything that isn't a straight line. You have to look at the full distribution to understand that tail risk. And you have to burn this into your mind. Relationships change, especially when the market is under stress.
This quote from our source material just sums it up perfectly. If you don't really grasp these deeper ideas about dependence and about how markets truly distribute their returns, then the very logic your entire portfolio is built on becomes unstable. You're essentially building a house on shaky ground.
And that really just leaves us with one final question for you to think about. When you look at your own financial strategy, what simple numbers, what unexamined assumptions are you relying on? Because the difference between the safety you think you have and the real risk you're exposed to, well, it might be hiding right there.